I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Here's a check of your first word news. For the first time since taking office, President Trump is headed to the state that's the anchor of the U.S. economy and the heart of the anti-Trump sentiment. The president travels tomorrow to California. He lost the state in the election by a 2-to-1 margin, and California's political leaders have since led the nation in challenging his policies. President Trump says he's waiting for court cases to be decided before acting on raising the age limit to buy certain guns. The president tweeted today that he'll be backing tougher background checks, though, for gun buyers, and he again pushed for letting trained teachers carry guns. NASA's acting administrator, Robert Lightfoot Jr., plans to retire at the end of April after a 30-year career with the agency. NASA is spending a second year without a permanent leader, with Congress deadlocked over President Trump's nominee. Lightfoot's resignation comes as the agency is looking to pivot back toward human spaceflight since the Space Shuttle program ended in 2011. And a pilot whose helicopter crashed in New York's East River reported an engine failure just moments before going down. All 5 passengers died in the crash. The pilot managed to escape and was rescued by a tugboat. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg.
Technology. Coming up, Dropbox's scaled back ambitions. The cloud company files to raise $648 million in its IPO, giving it a valuation well below that $10 billion it snagged in private fundraising. We will discuss. Plus, blockchain seizes the spotlight at South by Southwest. You will hear from the co-founder of Bitcoin rival Ethereum, Joe Lubin, later this hour. And Apple passes on acquiring Netflix or Disney, but goes all in on a digital magazine. First to our lead. It has been a while since Bloomberg first broke the news of Dropbox's plans to file for an IPO, and more details are now coming into focus on one of the most highly anticipated tech offerings of the year. Now, we have learned that Dropbox is planning to go public at a valuation somewhere between $6.7 and $7.6 billion, a number well below that $10 billion it clocked in its last private funding round. So what is happening here? To answer that, I'd like to welcome our Bloomberg Deals reporter, Alex Baringa, who first broke the news of Dropbox's IPO plan. So, Alex, break down the new numbers that we're getting here.
So what happened today is Dropbox set terms. So basically, they told Wall Street that they're marketing 36 million shares for a range of $16 to $18 a share. They're hoping to sell within that range for their initial public offering. That implies a market cap, as you said, about 25% below the $10 billion private valuation they clocked in their 2014 private funding round. So why is this happening? Well, what I've heard from a lot of people today is that Dropbox raised money at a time when valuations were really high, perhaps a little bit too elevated in private funding rounds, and now they're having to kind of take their salt. If you look back over the last few years in terms of what Dropbox has done with their business, it's actually fundamentally improved. They've gotten cash flow positive. They've gotten closer to profitability. Revenue is still growing at more than 30% clip, which is what public investors really want to see. But some of those premiums, perhaps the FOMO, fear of missing out premium, that is very real in private funding rounds, is not something that public market investors are wanting to bake into what they pay for the stock.
Now, a couple of other interesting details. They privately agreed to sell Salesforce $100 million in stock. They've also announced a reverse stock split, 1.5 to 1 for current inside investors, meaning those investors won't be as diluted. Explain what this all means.
So the dilution is basically to maintain that the employees and the existing investors do kind of hold the rights that they had beforehand. The Salesforce investment is really interesting. So this is a concurrent private placement. That means at the same time as they're doing the IPO, they're selling $100 million worth of stock to Salesforce. And this comes on the heels of a partnership announcement that they announced with Salesforce late last week, basically saying they will integrate Dropbox's products with the Salesforce customer relations management management software so they can basically upsell each other and integrate these two products. But not only is it a partnership, but now it seems that it's clear that Salesforce does have some skin in the game with this large stake. It's akin to what we saw with Comcast taking a big stake in Snap when it listed about a year ago, but that happened after the IPO. So interesting move here for sure from the likes of Salesforce pairing up with Dropbox financially.
We had Box CEO Aaron Levie on the show last week. This, of course, one of Dropbox's biggest competitors, though Levie calls them more like pseudo-competitors. You know, I asked him, is he concerned about Dropbox? You know, this is a company that is bringing in more money than Box. Take a listen to what Aaron Levie had to say.
Dropbox's numbers are sort of a tale of two types of companies. One is a consumer revenue business, and that's about 60 or 70% of their revenue. That's end users or consumers like you and I using it for either professional or personal use cases. And then about a third of the revenue is B2B. And so that is probably the only part of the business that looks anything like Box, and that tilts much more to small business or teams, whereas our revenue tilts toward mid-sized companies and large enterprises.
Alex, would you agree with his take that they don't compete as much as we seem to think?
Currently, that seems to be the case. Dropbox has 500 million registered users. Only 11 million of those are paying, which they haven't completely laid this out, but it seems like those would probably be enterprise accounts. One of the big differences is Box has a concerted sales effort. Dropbox doesn't. About 90% of the revenue actually comes from self-service, where you just sign up for the products that you pay for, and that kind of is the difference. You know, I know Aaron's competing with Drew Houston over at Dropbox, but it does seem like he and his company have been really focusing on the large accounts, while Dropbox is kind of pushing more of the guerrilla approach, land and expand, get in with some teams internally at its big companies, and then try to figure out how to sell across its customer base from there.
All right, Alex Barinka, our deals reporter, keeping it hot for us. Thank you so much, Alex, as always. Now, to another company going public, Spotify plans to list shares on the New York Stock Exchange the week of April 2nd. This, according to people familiar with the matter. The online music company will deviate from decades of common practice by not issuing any new shares in the IPO. Instead, existing Spotify stockholders will offer their shares to investors in a direct listing. Here to discuss more on this trend, David Golden, Managing Director at Revolution Ventures. David has been working in investment banking and M&A with a focus on tech companies for over 20 years. So what do you make of Spotify's decision here about how to approach this?
Well, Emily, I think Spotify's principal goal was sticking their finger in the eye of Wall Street, doing something a little disruptive, a little unconventional, something that hasn't been done very often, and they didn't need the money. And at the end of the day, a traditional...
So why do it at all?
Well, I think they had a clock ticking that they had to address. They had taken some money about 18 months ago from TPG and Dragoneer. The reporting at the time indicated that that money had a clock that made it more expensive with the passage of time, but the clock stopped when they were publicly traded. So one way to go publicly traded is do a direct listing.
Do you think other companies will follow this trend?
I think very few companies will follow this trend. It's very hard to do. You need a relatively dominant brand, and you need relative dominance in your sector, both of which they have, and you don't need the money. Most companies go public because they want to raise cash. Already Spotify had raised $2.5 billion. I think there was no shortage of additional capital from private investors, so they didn't need to go public to raise money. And most companies approaching the public markets need the money.
How risky is it for them, though?
I don't think it's very risky. I don't think it will achieve what they want to achieve. It avoids the embarrassment of something trading down, like Blue Apron traded down, and it avoids the roadshow where you have to go meet institutional investors. But other than that, it doesn't put any cash on your balance sheet, as we've just discussed. You have to spend months and months and months getting ready because the SEC requires essentially the same amount of work, the same amount of disclosure. And you're going to be public, which means you have to answer to investors every day now without having had the benefit of taking any money.
At a certain point, do you see them offering more shares on the public market?
I do.
And how long would that?
I think within 6 to 12 months, when the market price finds its natural level, Spotify will find the courage to say, okay, now we don't have to price it. We don't have to rely on bankers to price it. The market has spoken. Let's go raise a couple $2 billion for our own balance sheet.
Meantime, Dropbox going the traditional
way
route. You know, as we just discussed, you know, potentially at a lower valuation than it saw on on the private markets. You know, what's your take?
Well, I think the only people disappointed by that news are the investors in the most recent round that will be underwater. But for anybody who invested early in Dropbox, early to mid-stage, they're going to be just fine. And with all of Dropbox's principal competitors being publicly traded companies, they kind of didn't have a choice. If they want to use the stock as acquisition currency and they want to deepen the depth of their own balance sheet, they got to raise money. And if they can go public, more power to them.
Meantime, FanDuel also said to be taking a unique position to going public, not via an IPO, but a reverse merger. Explain how this works.
The basic idea is, and just to be clear, this is very old wine in very new bottles. This idea has been around for decades. They used to be called public shells. They used to be called blind pools. In the 90s, some young banker decided to call them special purpose acquisition companies. SPAC, exactly right. And the idea is the sponsors of the SPAC go raise a public shell. Investors put the money in, and then they have 2 years to go look to buy something. And the idea is that in this case, if it's true, they will buy FanDuel. And suddenly, overnight, FanDuel becomes a public company by merging with a public shell.
What do you make of the strategy? Is it a good one?
I think this is the classic example where the true scandal is not what is illegal, but what is legal. SPACs are perfectly legal, but they are the path of financing of last resort. If you can't go public any other way, if you can't get banks to take you out, if you can't get the markets to support you, if you can find somebody to buy you that's already public and it accesses a balance sheet, then go do it. But it's a bad deal for investors, a really bad deal for investors.
And is that a sign they don't have good interest from investors as of now? I mean,
yeah,
is that a sign the business isn't going well?
It's a terrible problem of adverse selection. You can find your way to a SPAC if every other door has been closed to you. Here's a little known fact. Since 2003, the average return for SPAC investors, negative 20%. The average return for SPAC sponsors, positive 1,900%. That's all you need to know. They take 20% right off the top of the value of these public shells just for organizing the effort.
Wow. Well, while I have you, I want to talk a little bit about Revolution and the strategy there. You know, we've had Steve Case on the show, and he has talked a lot about investing in other parts of the country outside the Beltway, outside of Silicon Valley. And right now, how many of your companies are outside of Silicon Valley?
Well, I manage the early stage venture fund, and all of our companies except one are outside of the Bay Area.
Why?
We find great opportunities, great entrepreneurs at a better price if you can get out of the echo chamber that is Silicon Valley. We meet everybody when they come through. We look at companies here. We have invested from time to time, but the deals are better elsewhere and the entrepreneurs are just as good.
The New York Times recently ran an article claiming that Silicon Valley is over. And, you know, it showed a bunch of VCs traveling to the Midwest, looking at companies in the Midwest. Maybe they're late to the party that Revolution already started, but, you know, what do you make of that assessment?
Well, I wouldn't say Silicon Valley is over. I mean, there's a tremendous amount of talent, world-class universities, a lot of capital. It's not going anywhere. As you know, it's been tempered recently by some arrogance that's been brought back down to earth. But there are 49 other states, and they're not devoid of entrepreneurship. They've been devoid of significant pools of capital, and that's starting to change. I think it's a good outcome for the nation. I think it's a good outcome for my industry.
So where are you looking to place your bets this year?
Well, we look at young companies. We typically invest Series A, Series B. It's a $5 million check. We like entrepreneurs that are scrappy. We like entrepreneurs that have put companies together without a lot of money, but they're focused in big categories where the incumbents are kind of fat and lazy and looking the other way. And that can be an enterprise play. It can be a consumer play. We're in Policy Genius, which is a new way to buy life insurance. We're in FrameBridge, which is a new way to frame what's traditionally been a very labor-intensive neighborhood framing store for photographs or your kids' memorabilia, that sort of thing. Really big markets, but new innovative ways of doing things.
All right, David Goldman, partner at Revolution Ventures. Thanks so much
for
stopping by. Great to have you. Now to another top story. Goldman Sachs has paved the way for co-president David Solomon to be the next CEO. Solomon will become the firm's sole president, and the other co-president, Harvey Schwartz, will be leaving. Goldman's given no timeline for the retirement of CEO Lloyd Blankfein. Early last month, we sat down with David Solomon at the Goldman Sachs Tech Conference and talked about the tech sector. Take a listen.
The year has set up in a way that I think it should be very, very constructive, both for M&A activity and for IPO activity. You know, IPO activity started to pick up a little bit toward the end of 2017. We've got a very, very healthy IPO backlog. But we also have an environment, for a variety of reasons, why 2018 should set up to be a pretty active year for strategic M&A in the technology space.
Coming up is Broadcom's hostile bid for Qualcomm, a threat to U.S. national security. Why its CEO was meeting with U.S. Treasury officials next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. A story we are watching. One of VMware's biggest investors wants the board to end talks with Dell about a reverse merger. Jericho Capital Asset Management argues it would be a terrible deal for both the company and shareholders. Billionaire Michael Dell controls VMware as well as his own namesake company. He's trying to bring all the pieces of his empire under one publicly traded roof. Well, Broadcom CEO is trying to salvage his company's $117 billion takeover of rival chipmaker Qualcomm. Hock Tan met with Treasury Department officials to address U.S. government concerns over possible national security concerns about the deal. You can see Tan there when he met with President Trump in November. His meeting came after a letter from Treasury to companies Sunday that said national security risks from the takeover may prompt the president to veto the deal. Concerns are the deal could hurt Qualcomm's competitiveness, thus allowing China to expand its influence over key wireless technologies. For more, I want to bring in Bloomberg Tech's Ian King, who covers chip makers. Boy, another twist, another turn, another day of reporting on this possible takeover.
That's right.
What's happening here in the latest?
So this morning we got a letter made public from the Treasury Department, basically on behalf of CFIUS, saying we don't like this. You know, another letter saying, you know, not only do we not like this, but we found some evidence that says there are security concerns, that you took action that we told you not to take, and that we want an explanation, or else we're going to take this to the president and he has the power to veto the deal.
So, you know, at this point, what is the likelihood of this actually getting done?
I mean, you know, you've asked, obviously, we've been talking about this for a very long time now already. If the shareholders want it, right, according to what we've reported, Qualcomm shareholders have already basically voted with their feet and said, we want Broadcom to take control of this company. But that may not matter because the US government may have the veto.
Is it a threat to national security?
That is part of the problem. If you read what the government said, they basically threw everything in there. There was a huge variety of things in there. Contracts that Qualcomm has, a combination, a commitment to R&D, all of these things which may or may not be a problem. The issue is that they don't really have to say specifically what is bugging them. All they have to do is say, we have an issue, come and explain yourself.
So, you know, meantime, Broadcom is speeding up the process of moving its headquarters to San Diego. How does that fit in? Yeah,
that actually got them in trouble. The idea was if they come back to this country, if they move their registration back to this country, then there'll be a US company again, and what will the problem be? What CFIUS said was, hold on a minute, you told us you were going to do this in May, now you're doing it in April. We don't like that. You should have told us.
Meantime, no rest for the weary and no rest for Ian King. This after the Wall Street Journal reported that Intel was considering a bid for Broadcom.
That's right, yes. On Friday, our competitors...
Your day off.
my day off, yeah. Our competitors came out with that. I mean, our reporting showed that perhaps isn't the most likely thing in the world, that, you know, it's logical for a large company like Intel, which may be impacted indirectly by this deal, to look at how it might intervene, to look at, you know, to play out the scenarios. That's our understanding of about as far as Intel had got in terms of involving themselves.
So not advanced at this stage, but could it become more realistic?
Right. I mean, a couple of things there. Huge deal, whichever way you stack. It's already a huge deal to try and buy Qualcomm. It would be a huge deal to try and buy Broadcom. The government clearly isn't in favor of these giant combinations right now, or at least that's the way the wind looks like it's blowing. How likely might that be? Probably not that likely, but who knows at this point.
So what is the timeline for a Qualcomm-Broadcom deal to be potentially blocked or not?
Okay, so as it stands now, 30 days, which would in theory take us to early April, in time for the new shareholder meeting to come in and say, here you go, Hock Tan, it's your company. But as we reported, that isn't the most likely course of events, normally what CFIUS does is come back and say, you know what, this is complicated, we need another 45 days, which would take us into the middle of summer.
All right, Ian King, keep fighting the good fight. Thank you so much for giving us the play-by-play, as always. Bloomberg's Ian King. All right, coming up, our exclusive conversation with London's Mayor Sadiq Khan from South by Southwest. His message to Uber next. And Bloomberg Technology is live streaming on Twitter. You can check us out at Technology weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. South by Southwest is in full swing, attending the Tech, Music, and Entertainment Conference in Austin, Texas. The mayor of London to drum up business for his city. Speaking to Bloomberg Daybreak Asia, Khan had stern words for companies like Uber, saying they have to play by the rules if they want to do business in London. The mayor also explained why London is the place to be when it comes to technology.
There are a number of reasons why tech companies, scale-up startups, tech giants come to London. The main reasons are access to talent. We have a talented population in London, and we're investing in the next generation having the skills for the jobs of tomorrow. Secondly, access to capital. London is a place to come to, cultural capital of the country, political capital, and financial capital. But thirdly, our ecosystem. The proximity, cheek by jowl of culture, creativity, tech, politics, politicians, regulators, and finance explains why 40% of the world's companies have their European headquarters in London. 40%. Number two, by the way, is Paris with 8%. And so London is a great city to start a business, to scale up a business, to come if you're a big company. It's going to stay that way while I'm mayor.
Oh, of course, we've seen the likes of Google, Facebook, investing in some big European headquarters in London as well. I mean, Uber certainly, though, has been the big headlight, I guess, or in terms of being under fire under your administration when it comes to being their license getting revoked. What do you need to see from the company here for them to continue to operate in the City of London?
Well, look, Uber is a very popular service around the world. The idea of linking an app to a taxi is very, very popular. But my message to Uber, and a message to everyone, no matter how many lawyers you employ or PR experts, is you've got to play by the rules. The rules are there for everyone. And if you play by the rules, of course you can do business in London. I want London to be a place where disruptive companies come, where tech companies come. But you've got to play by the rules. The good news, the newish global CEO of Uber has a very, very different attitude to the previous CEO.
Right.
And the noises coming from him and the language from him bodes well for the resolution of the differences the regulator has with Uber.
London Mayor Sadiq Khan there. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Here's a check of your first word news. Secretary of State Rex Tillerson shortened his first trip to Africa in office. He'll now return after spending just a few hours in Nigeria today instead of spending the night as originally planned. Tillerson spoke in Chad before taking off for Nigeria.
The United States values Chad as a strategic partner in this region. We know that Chad faces many security threats on each of its borders. We appreciate Chad's important role in providing security for its own citizens and its contribution to the security of its neighbors as well.
Chad is a U.S. ally, and it expressed disappointment over its inclusion in the Trump administration's travel restriction list. British Prime Minister Theresa May says the Russian ex-spy poisoned in England was exposed to a military-grade nerve agent of a type produced in Russia. She told lawmakers today it was, quote, highly likely Russia was responsible for poisoning Sergei Skripal and his daughter. Israeli Prime Minister Benjamin Netanyahu says it is too soon to call early elections, but the options on the table. His coalition is feuding over granting exemptions from military service to ultra-Orthodox Jewish men. Netanyahu is also facing a corruption scandal. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Just after 5:30 p.m. here in Washington, 8:30 now Tuesday morning in Sydney, where we are joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning to you.
Yeah, good morning, Lisa. We have a market up and running already in this part of the world. The NZX in New Zealand are trading for 30 minutes and already up about a 1/10 of 1%, 2/10 of 1% now. This is after a kind of a mixed lead from Wall Street. We saw the Dow and the S&P weaken. The Nasdaq, however, hitting a record high, up 1/3 of 1% there. Still some uncertainty remaining over tariffs and exemptions undoing some of the job-driven gains we've seen in the US. Take a look at futures around the region. We've got ASX futures stronger by just 3 points. Nikkei futures, meanwhile, weaker by 0.5%. The Aussie dollar looking pretty steady at 78.73. Little change to the Japanese yen there. Let's take a quick look at commodities. The commodities complex all looking a little bit weaker. Gold a little changed at 1,323 an ounce. Crude easing off a little, and iron ore futures as well weaker by 1/5 of 1%. Also, keep an eye on things happening in Hong Kong today. The Hong Kong dollar nearing the weekend of its trading band. If it does dip below $7.85 or hits $7.85 US, the Hong Kong Monetary Authority will have to intervene. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Emily Chang. Back to our top story, tech companies going public. Earlier in the show, we took a look at Dropbox and Spotify's plans for their public debuts. Dropbox going the traditional route, Spotify bucking convention. The streaming giant is planning a direct listing on the New York Stock Exchange the week of April 2nd. For more, I want to bring in Bloomberg's Caroline Hyde in London, who is standing by with an early Spotify investor for an insider's take on their route to IPO. Caroline?
Emily, thank you. Yes, it's a man who sat on the Spotify board for years, a man who made sure that they were in on the funding round back in 2008. It is PJ Parson. He is a partner at North Zone. Wonderful to have you here in London.
Thank you, Caroline.
PJ, why this way of listing for Spotify?
Well, I think Spotify doesn't really need to raise money. It's a company with lots of cash, as you can read through the F1 filing documents. And they are also a very well-known brand. So I think this is rather unconventional, but it really serves the company's purposes.
But they're up against competitors such as Apple, which have phenomenal amounts of cash. Surely at some point they will tap the market, because why else have the availability of going public at all?
Well, I think it really starts with the relationship with the consumers that are using the product. And Spotify has, since the launch back in October 2008, consistently been one step ahead of the competition and been extremely good at delighting and surprising the customers with products and suggestions, playlists, and curation that is just heads and shoulders above what the others were doing at the time. And then Apple, which is probably what everyone is thinking about here, they came to the market quite late. They bet on download as being the predominant way to deliver music, and it turned out that that was the wrong choice to make, and they came too late to the party, consequently.
And so Spotify, you think, will always be able to remain a step ahead, even when perhaps they might find avenues becoming blocked. We're looking at voice assistants becoming the way in which we consume our music nowadays. I use my Alexa and my Google Home. We've now got the speakers coming out from Apple as well. Will they not start putting up roadblocks to allow such a seamless use of Spotify?
It could very well be a change in how people want to consume their music with voice assistants. But, you know, Spotify is one of the skills in Alexa, for instance, and is functioning really, really well there. And also, we see no reason why it shouldn't be in all the other devices. That has been one of the hallmarks of Spotify's success, that they have been ubiquitous in pretty much every device there is. There is an integration that Spotify has done.
So they don't need, well, they don't need to tap the market now. they can list in this novel way, why come to the market now then? What is it that's driving them?
Well, I think it's fair to say that the founders, Daniel and Martin, they early on understood that this was a capital-intensive business, and they needed to rely on the private capital markets, and they raised quite a lot of money over the years, and the sort of underlying promise to most of those investors, including us, is that at some point in time there will be a liquidity event, and when you're building such a phenomenal company as Spotify, the best way to get to that point is through a listing.
And so you will be sellers on that first day of trade?
So we are owners since 10 years, and this is a fund that is in the very latest stage of its existence. So it's natural that we will, at some point in time, exit our position there. It can be done in various ways. One is to sell, of course. Another is to distribute our shares that we hold to our fund investors. And we know that quite a few of our fund investors are really intrigued about the long-term prospects of Spotify, and consequently that could be a very well-functioning option as well.
What price would you have to see for Spotify to exit?
It's very hard to say, but there are obviously many good comparables and peers that you can peg Spotify against, and
like who?
I would say Netflix is a pretty good one for many reasons.
It can get to their valuation, you think?
Well, it has a similar gross margin. Spotify has a stronger growth rate. It's international. It has counts massive amount of subscribers. I think what's perhaps even stronger with Spotify is that it's a much more cash-efficient model, because Spotify gets paid on day one for their subscriptions, and they don't have to fund entire productions that Netflix does, and consequently the cash required to run the operation at Spotify is substantially less.
You talked about how this was a liquidity event which investors such as yourself need. What does it mean, therefore, this sort of liquidity event mean for the European tech ecosystem?
Oh yeah, I think it's phenomenal that we have the biggest listing ever of a technology company now happening, and coming from a small country up north, and it has really fueled a dynamism of the particularly the Stockholm ecosystem that during my 22 years as a VC has really surprised even me. And there are lots of companies now springing up in the sort of in the shadows of Spotify and Klarna and a few of the other big players that consist of people who have gotten their first experience with these great companies, and Spotify is probably the biggest and the finest of them all. And
we've got to go, but I've got to ask you one thing. Will we see these listings be copied? Will we see other people take the route to Spotify?
I think very few companies could match the kind of branding required. So I think the Goldman Sachs and the Morgan Stanleys can still see a good business ahead.
PJ Parson, it's been wonderful having you here. Thank you so much. Great to have him over, of course, partner of Northzone. Emily.
All right, Bloomberg's Caroline Hyde in London. Thanks so much, Caroline. Well, WeWork wants a bigger piece of the booming Toronto office market. The tech startup, which specializes in shared workspaces, wants to occupy at least 20 different locations in Toronto by 2020, up from 3 locations right now. WeWork's first offices in Toronto last year were 98% occupied within the first month. WeWork, which has $4.75 billion in funding, is benefiting off a global shift towards shared offices and freelance contracts. Coming up, Apple is making another big push into video, and it's not by acquiring Netflix. We will bring you all the details next. This is Bloomberg. A story we are watching: Tesla temporarily suspended production of the Model 3 electric sedan for a week in late February. It was a planned breather that ultimately may help increase output of the closely watched vehicle. Model 3 production was idled from February 20th to 24th. Tesla's Model 3 production rate has been an endless source of fascination for fans, reservation holders, and investors alike. Bloomberg has developed a tool to estimate output. By late February, Bloomberg's Tesla Model 3 tracker indicated that the weekly production rate had plunged. Well, Apple Services chief Eddie Q took the stage at South by Southwest and suggested Apple isn't interested in buying Netflix or Disney and instead will build out its own original video content. The tech giant is, however, buying the digital magazine Texture for an undisclosed amount. The acquisition is part of Apple's subscription push and will boost its efforts in online services and media. The Texture app lets users subscribe to more than 200 magazines for $9.99 a month. Joining me now, Bloomberg Tech's Tom Giles, our executive editor for tech. So what exactly did Eddie Q say and not say in this conversation?
Right. So he was asked, well, why don't you just buy Netflix, give or take? And his response was, he didn't talk about Netflix directly, but he talked about how they don't make big acquisitions. He talked about how they want to focus on quality, not quantity. He mentioned that they're not looking to buy a studio. They don't want to get into that business. So, and remember that Apple has been focusing on its own video content creation business. It's got about 40 people in this business. They hired a couple of executives from Sony Pictures TV. That came out several months ago. So they've got their own effort underway. It doesn't sound like they want to go and create this big splash, big acquisition along the lines of Netflix. It's just not in their DNA to go out and make these really big tens of billions of dollars acquisitions.
He said that they aim to produce a smaller number of quality shows rather than quantity. That said, I did ask Tim Cook almost the very same question on earnings day, and he told me, we look at companies tiny to big and ask ourselves, would these companies improve the lives of customers? Can we build a better product with it? That's how we decide. We acquired 19 companies in 2017. That's a company every 2 to 3 weeks. We stay constantly in the market. So again, certainly not a definitive answer there, but I had specifically said, why not buy Netflix? Why not buy Tesla? And he didn't close the door.
Well, maybe he sent you a signal that Eddie Q certainly wasn't trying to convey at South by Southwest. And you saw the other acquisition that you mentioned, Texture. That's very much more in keeping with the kinds of deals that Apple likes to make. This is another service that they can add, that they can, develop that service revenue, stream of revenue that they've got going there. They really want to make a big push there. And this is also a good way for them to curry favor with publishers who are feeling really snubbed by Facebook and Google these days.
How does this fit into the Apple News strategy?
It's another way that you can go to Apple and get access to the kinds of publications that you subscribe to. And again, it's also a way to show that you're working with the subscribers, you're on their side. Remember that Facebook made some changes to its algorithm recently whereby publishers really feel shortchanged. Google has this, there's a love-hate relationship with publishers. On Google, it's a great platform, it's a great way to distribute our stuff, but are we getting the play that we think we deserve? And can we actually build our subscriber base through Google? Google's definitely been making some efforts in that direction, but Apple, I think, is trying to say, look, hey, we're really friendly to publishers too.
All right, Tom Giles, our executive editor for Tech. Thank you, as always, for stopping by. Coming up, we head back to Austin and South by Southwest and talk with the man who co-founded the world's second largest cryptocurrency. That is next. This is Bloomberg. Speaking of Netflix, it is still the year's best S&P performer, but shares fell Monday after a double whammy from Citron Research and Apple. Citron's Andrew Leff noted in a tweet that the streaming giant's market cap had ballooned by $17 billion this month alone, but its shares can be shorted down to $300 a share. Netflix is up 66% this year. And back to our coverage from South by Southwest in Austin, which wouldn't be complete without a spotlight on blockchain. Bloomberg spoke with Joe Lubin, who co-founded a company called Consensus that aims to build tools and apps needed to enable a decentralized future through blockchain. But he is perhaps better known for being the co-founder of the world's second largest cryptocurrency, Ethereum. He talked about blockchain's role.
We had an event where we had probably 4,000 or so people in attendance. We're running a lounge, the Ethereum Lounge. Consensus is running that, and we've got right now a Women in Blockchain event going on as we speak. We've had events with Stephen Wolfram of Mathematica fame, and a full slate over the last few days of those sorts of activities, but also just walking around, being in all the different events around the area. Everybody's talking about blockchain either in the event or just peripherally.
When they talk about blockchain, to what extent are they not really highlighting Bitcoin? I point that out because the Bitcoin bubble has seemingly burst, even as there's a lot going on once you check out the price action of some of the other platforms and look into the demand for blockchain and for cryptocurrencies at large.
Well, it may be hard to tell because we're so focused on Ethereum. We're so focused on building decentralized applications on the Ethereum platform. We're so much less focused on cryptocurrencies like Bitcoin. Consider Ether to be a crypto fuel that powers applications on the decentralized World Wide Web. But I would argue that we've seen a correction in our space, but calling the bubble to have been popped is a little short-sighted. I think there's tremendous foundational, fundamental work being built in our ecosystem, and it's very, very early days for the ecosystem.
Joe, throughout the first several quarters of 2017, we saw an explosion of initial coin offerings, many of which were built to run on top of the Ethereum network. Of course, lately there's been a lot of anxiety about a regulatory crackdown and the status of many of these coins. How much does that threaten the interest in Ethereum if one of the main applications of it is under so much regulatory scrutiny?
So we're extremely happy about how things are going globally with regulators. There are many different jurisdictions that are excited about tokenized securities or utility tokens that wouldn't be considered securities, and that's actually true in this country as well, in the United States. There are many great applications being built worldwide on Ethereum and with other blockchain technologies, but there are many bad projects and there are many fraudulent projects. So it is perfectly reasonable for a bit of a pause in our ecosystem. It is important, I think, for many projects to do their legal homework and issue tokens properly.
You talk about all the projects that have been launched on Ethereum that you describe as promising. The underlying platform, though, still is not particularly robust with respect to scaling. A few months ago, there was a collectible cats card game that basically brought the whole thing to a halt. What is the timeline of a roadmap where someone can launch something and it can be sort of expected to really run without slowing down the network?
So it is remarkably robust with respect to security, and throughout history, software developers have been pushing the bounds on scalability for every platform that they've been on. We've traded high transaction throughput for this new trust infrastructure that enables better collaboration. We are seeing technologies like state channels. We're seeing technologies like Plasma that's going to ramify this year in the next few months for different kinds of applications. The CryptoKitties application was one excellent test showing us where some of our clients were weak, and some of those issues have been fixed already, and it shows us how we can build better, more scalable architecture. So short term, there will be some excellent fixes in 2018. Over the next 2 years, we're going to see dramatic scalability increases.
That was Joe Lubin, co-founder of Consensus, speaking at Bloomberg from South by Southwest in Austin, Texas. Well, last week, all the talk was about Amazon possibly offering checking accounts, and now it's all about a new Amazon credit card. Amazon is said to be planning to offer a credit card to its small business customers who shop on the site. Amazon is in talks with JPMorgan Chase about this new product, which will feature reward points for purchases and eventually add offerings like business insurance through a portal designed for its small business customers. Meantime, Jeff Bezos says he is committing his, quote, Amazon lottery winnings to space travel. The billionaire didn't disclose an amount, but did say he wants future generations to have a world that is expanding and growing. Bezos spoke at the Explorers Club dinner in New York City this weekend, where he sampled iguana. Yes, iguana, and received the Buzz Aldrin Space Exploration Award. That does it for this edition of Bloomberg Technology. A reminder, we are live streaming on Twitter. Check us out at Technology, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. That's all for now. This is Bloomberg.